Hello, guys. Welcome to the show this afternoon. Now, here's the thing. I'm documenting the big crash as it's unfolding right here on this channel. The thing is I don't think it's ready quite yet. I'm going to explain to you why. I tell you what, I think we're going to make it through Christmas and into the new year before we really get it. In the chops, the big crash. The thing is, and I'm going to point out to you why I think this. Let's get right into it. Let's open up the charts and take a look at what's going on here. So what we're looking at here, we're looking at the Dow Jones, the run-up, the big run-up, all the enthusiasm, stock buybacks, tax rebates, everything else. And the big run up here. Woo! Look at it go up, and it reached a crescendo in January of this year. And then we had a fall. Scared everybody. Oh yeah, scared everybody. The fall. But believe it or not, the Fed came into the rescue. They injected money into the system, and we seen a rise up here. We seen a rise up here. And then it's bumbled along, and then we seen a little more. We seen actually a top right here on the 10th, the 3rd, 2018. We seen a top, and now what we've seen is this little thing that we've just had, and here we stand right here. This little fall that we've just had, something similar to what happened in January. What we've just been through. I'm going to tell you what. Watch the bond market. This is your key to the stock market. Let's take a look at these bonds. Let's take a look at what they're doing. Specifically, let's take a look at the 10-year, the U.S. 10-year. This is what's held the market crash off, and I'm going to show you exactly what held the market crash off and why it didn't happen like in October or now. Why it hasn't happened yet. Is got to do with this 10-year right here. Let's take a closer analysis of the 10-year. And let's take a look at what's going on here. Now, you remember I said the mark is 3.25%. What happened was we started to approach that mark twice. We first approached the mark on the 10th to 5th, 2018. And we approached the mark again on the 11th, the 8th, 2018. So two high points. Let's take a closer analysis of these high points. Probably get them in the 6th month here. You can see here's the high point right here and here in the U.S. 10-year. And what's happened is you see these times when it chopped down, it fell down. It fell all the way down to 3.07, and now it's fell down to 3.06. This is bond buying. We see 3 episodes of bond buying. One here, and one here. It's this massive bond buying, bond purchasing, is coming from investors who are scared. They're scared. And they're looking for safe haven. Believe it or not, they're also looking for yield. Believe it or not, the bonds, the bond market, is where they're running to as a safe haven in the storm right now, right at this particular moment. In my mind, I see it like jumping out of the frying pan into the fire. But to investors, they don't see it that way. They see this as protection from the storm that they see approaching. So we've seen heavy bond buying on more than one occasion here, and this has kept the bonds at a level rate going back all the way back to September 19th. Okay, September 19th. We haven't moved. The 10-year really hasn't risen since September 19th, 2018, when it was at roughly 3.08%. Now it's at 3.06%. So we basically we've had a couple peaks, and these peaks have caused problems in the market, and we're seeing one of the problems from this last peak right here. This is what we're seeing in the market right now, with the market falling as much as it has. But because the pressure's come off, and we've taken the steam out of it now, and the bonds are down to 3.06 on the 10-year, right? We're probably going to see the market. Now, right now, the market has fell 500 points today. But we're probably going to see is a few, I'm not going to say great days. Nothing where the market's going to go up like 1,000 points or anything like that. But we're going to see some days maybe where the market goes up 200-300 points possibly. And people start to feel like, hey, you know what? This is settling in. It's not the crash. And that's going to carry on, I think, right up till Christmas. Unless these bond yields suddenly spike upwards quickly. And I don't think they're going to. I think they're going to creep up. I think they probably, before the end of the year, I could see this 10-year creeping up from 3.06% to possibly 3.18 or something like that. Maybe 3.20 or something like that between now and Christmas. And what we're going to see probably is the stock market probably going along at about the level it is now, maybe a little bit higher. You know, and the fear is going to go away. And when the fear goes away, this bond trade that's going on now is going to start to settle back. And we're going to see these bond yields start to creep back up again because they're not going to be buying in as heavy as they are. This has been a fear trade. And it's not extreme fear, but it's a rational fear that they know that the market is that the stock market's oversold. Bond yields are now up to the point where they can make pretty good little bit of interest on them. You know, and so seriously, that's where they're going. They're not going into gold, silver. They're not going into cryptocurrency. And, of course, that's obvious when you look at the price movements of gold, silver, and cryptocurrencies. That's all going to change, guys. It's going to change when the real serious fear comes into the markets. When the real serious fear comes into the markets, the U.S. debt's going to be put into question at that point. And that's when the bond yields are really going to start to spike. That's also when the market is going to really start to crash down, and we're going to see some real fireworks. I'm going to tell you, I think we're going to make it through the Christmas season. I think we're going to make it into the new year, and I think that's when we're going to see this U.S. 10-year go over 3.25%. It doesn't surprise me at all that the cover of the Economist magazine for 2000, it shows 2019, and it just shows blackness. Maybe that's a signal like for what they call Black Mondays or Black Fridays or whatever, when the stock market just basically completely rolls over. I'm serious. This is going to be bad when it finally really hits. There is going to be just like in a game of poker, who's going to fold, you know? And you get two strong players, who's going to fold first? Who's going to yield to the other guy? And what we have is we have the Fed on one side, and we're going to have the falling markets on the other side. And how long, the real big question mark here is how long is the Fed going to continue with their tightening monetary policies before they relent? When this market starts to really turn over bad and we start to see this market folding up on itself. We've seen some fireworks in this market so far, and it's shaken a lot of people. A lot of people say, okay, we're in the crash, we're in the reset, everything else. It hasn't quite happened yet. When it really happens, when it really starts to happen big time. Now, we're in the prelude that's leading up to it right now. That's what's happening. We're in the prelude. But I think we're going to get through Christmas. So that's the good news, you know. We're going to have a Merry Christmas, you know, and everything else. But by God, you know, I mean, I think the next year is going to be the worst year of our lives as far as this is concerned. It depends on how you're invested, though. It might be the best year of your life if you're not in counterparty risk. I've talked a lot about counterparty risk, and all of these financial assets have tremendous amount of counterparty risk attached to them. what it is all the money has been actually created from nothing. And it can all fold back in on itself. And quick. Once things start to sell off, it's fine and well to have counterparty risk when the bubble is inflating. You can make a lot of money, but when you have risk assets with counterparty risk attached to them, and the bubble starts to fold up, and everything starts to crash down, then basically everything gets marked to market. What's it really worth? All the assessments, what are they really worth when you have to actually sell and liquidate those assessed values? And money is scarce at that point. This is called deflation. And this is what this is all about. And I've been talking about this deflationary spike event for a long time. What the people on one side of this trade, the people who are playing this deflation, are missing. And yes, you can play this deflation. You can wait until the almighty dollar goes skyrocketing from the deflation and everybody is liquidating all of their assets and your dollar's worth more and more and more. But what they're not realizing is that the Federal Reserve can create as many unlimited amount of dollars. This is why the United States can never actually go bankrupt. They're not going to let it go bankrupt. You see, when this crisis hits, this deflationary crisis, it is going to bankrupt everything if they let it continue, including the government. It would bankrupt. It would fold in. It's almost like some sort of a big vacuum cleaner sucking up all liquidity. Once it gets rolling, it's a self-feeding cycle. Prices fall, and there's not enough people out there to have enough money to buy anything. It makes prices fall all the faster. And I mean, it just, the whole thing just, everything starts to fold in on itself when this happens. They cannot let that continue. They have it within their power, money creation as a tool. And they've already told you their policy. The Federal Reserve has said very clearly that it's all data dependent. Their tightening that they're doing now is all data dependent. They've already told you. And Ben Bernanke, he's already told everyone out there, he said, if we have to, and this is why he got named Helicopter Ben, we will dump money out of helicopters. Now, okay, if Ben Bernanke was up there dumping money out of helicopters, him and Janet Yellen, and the Fed director we have now is down on the ground, and he's telling them where to fly a helicopter, then how much is your dollars going to be worth then at that point when that money starts to hit the ground? I mean, this is basically the size of it. That's why he got called Helicopter Ben. He wasn't really talking about literally dumping money out of helicopters, but they can start programs so quick that it can make the eyes spin in your head. Universal basic income, tax rebates. I mean, the list just goes on and on. More quantitative easing. They can double the amount of quantitative easing. They can make it, instead of $80 billion a month, they can make it $160 billion a month. They can bail out multiple banking systems with liquidity. I mean, the list goes on and on to what they can do. They can quite literally create as many dollars as there are leaves on the trees out there. So then all these people that are playing the deflationary trade, okay, they're out there playing the deflationary trade. They're trying to buy everything up on the cheap while the deflation's on. The deflation can end so suddenly, it can end overnight. And then you can get trapped. Unless you're one of these really, really rich guys that knows how to get out quick with computer algorithms and stuff that can actually do a trade at the speed of light. If you're one of these guys, you might be able to get out in time. But even they might not get out in time when this deflation ends and the Fed turns things around into accommodative monetary policy again. That's what's going to happen. There's no two ways around it. I mean, my forecasting here on this, the trend that's coming with first deflation and then hyperinflation. I mean, it's mathematical certainty that this crash actually has to occur, and soon. We've entered into a period where monetary expansion is what they call a hockey stick. It's where where basically the amount of money out there that's created with this credit expansion starts to go up exponentially. And this is what the Fed's fighting against with their tightening policies. So, I mean, what do we got coming? What we got coming is exactly what Mike Maloney forecast years ago. I got to hand it to the guy. He called it the roller coaster crash. He said that the deflation's going to hit. In fact, way before the crisis, even before the crisis of 2008, he said that the Fed would react to a moderate amount of deflation, and they would overreact, and that's exactly what they did. And then he said that then there would be real deflation would come along, and that's what I've been forecasting, this deflationary spike event. And he said then the Fed would react again and put us into either a tremendous inflation or a hyperinflation. He's called it. That's it. That's basically what I see coming as well. But here it is. It's probably going to be it's probably going to be in the first quarter of 2019. And the reason why it's been delayed is because of all this bond buying. Tremendous amount of bond buying. I didn't expect so much bond buying. I expected these bond rates to rise and there to be no buyers. And when I first saw the bond yields rising and falling back, I thought the Fed was perhaps I thought the Fed was buying them on the sly, you know, because. But then later I started to realize, hey, you know, it's not the Fed that's buying these things; it's investors buying them, these products, because they're trying to get into something safe when the crash comes, and it's liquidity pouring into this market. And that's what's changed the whole format, the whole scheme of things, and advanced it off a few months off into the future, into probably January, February, or March, sometime in then, but with a real big crash is coming. So maybe it's good news, maybe it's not. If you've been waiting for this crash to come for a long time, if you're a lot of people, some people are, they want to make money with it, you know, and I'll tell you what. Thank you guys for listening. I'm rattling on a little bit. We'll catch you in the next show. Bye-bye, guys.